All right, so let's just keep things rolling here on transaction 5. Remember now, I just want to point out again, this was chapter 3. This is a review from chapter 3. This is the original entry, right? So this is what we did. I'll repeat it. This is what we did in chapter 3. Okay, so the journal entry we know is correct here. We had an increase to an asset, the supplies account. And we had an increase to the liability, our accounts payable. We knew it was a liability because it says payable, right? So we purchased supplies on account for $14,000. This is all well and good. We talked about this in chapter 3. So let's talk about what happens at the end of December, at the end of that month, okay? So at the end of December, account of supplies, and that's what you'll see is they're kind of doing an inventory of supplies, and they'll say, hey, you've only got $4,000 of supplies remaining. Good tip here. Supplies remaining. Okay, when you see supplies remaining or you see inventory remaining or whatever the case, just know that means that is your ending balance. Okay, good tip right there. When you see remaining, it probably means you're going to have to do some math, but it also means that it is your ending balance. Okay, so account of supplies reveals that you have $4,000 of supplies remaining. How much was used in the supplies account during the period? Well, it's pretty simple math. Anybody that told you that you have to be good at math to be an accountant is wrong. This is simple addition and subtraction. So we're going to start with our beginning supplies balance, that $14,000. That's what we purchased on December 1st, right? That was what we purchased. Okay. Then we're going to go with our ending balance, right? What was left. And we're going to solve that equation. So we're going to say $14,000 minus x equals 4,000. And you just solve that and you get x equals 10,000, right? Don't think I need to go through the steps to solve a single variable simple equation like that, but if you do need help with that, please contact me or one of the GAs and we will show you how to do that. But you get your $10,000. So what the timeline is saying is here is on December 6th, when we made that purchase, we had $14,000 of supplies. Throughout the month, we used X amount of that supply, and we have $4,000 left on December 31st. How much did we use? $10,000. Okay, so now we're going to make the journal entry for that, or we're going to start talking about the journal entry for that. So what accounts are affected? Well, supplies and supplies expense, right? Because now that we've used some of those supplies, we have to recognize the expense. Okay. So again, we are just saying these supplies, the use of these supplies, the use of this resource helped us to generate revenue in this particular period. So we're going to recognize that as an expense. We're going to match that expense to the revenue that it generated, okay? So do the accounts increase or decrease? Well, we're going to increase our supplies expense account because remember, an increase in expense is a decrease in equity because we have equity, common stock, retained earnings, net income, dividends, revenues, and expenses. An increase in expense is a decrease in net income, which is a decrease in retained earnings, which is a decrease in equity. Again, be able to do this on an exam. Be able to follow that logic all the way through. Okay, and then our assets are decreasing. We have used up some amount of that resource. Okay, in this instance, we know that we have used up $10,000 worth of that resource. Okay, so do our assets still equal our liabilities plus stockholders' equity? Yeah, because we had a decrease in assets and stockholders' equity. This note is just to tell you, hey, remember that increase in expenses is actually a decrease in equity, but we showed that up here as well, right? So, and then you can just look here at our chart and we see our balance for supplies on December 6th was $14,000. When we went back and re-inventoried and checked, we had a balance of $4,000. So that told us there was a decrease in that account of $10,000, which would be an increase in an expense of $10,000. So what does the actual journal entry portion of this look like? Our debits and our credits? Well, pretty easy. Again, this is just our adjusting entry. And what do we do with adjusting entries? We are adjusting the balance, right? So it is correct. So an increase to supplies expense, again, just look at our DEAD acronym. This is something I would, again, ask you guys to write as often as you can. Our debits increase our expenses, assets, dividends. Okay. So what is this? Well, it's an expense. It tells us right in the name, right? So that's an increase to an expense, which means it's going to be a debit because it lives right here in the expenses. Supplies is an asset which lives right here, but we're trying to decrease it. So we're doing the opposite, and we're going to credit it. Okay, and that's a decrease to your asset. $10,000. You see that our debits equal our credits, so we are good to go. Everything is in balance. This is, accounting's version of the light and dark side of the force, right? Everything must be in balance, and if it's not, there's a real problem. So just keep that in mind. Now we're going to backtrack a little bit to transaction 3. Now again, I'll remind you, this is a review from chapter 3. This is our original entry when we purchased equipment necessary for customizing robots for $240,000. We had that key term purchase. For us, that meant cash, right? Okay. And then equipment, what did that tell us? That just told us this is equipment. It's an asset. It's an increase to the asset. It's a decrease to cash. Okay. So we increased equipment with a debit. We decreased cash, another asset, with a credit. This again was a net zero effect on the equation, right? So let's take a look at what's happening at the end of the month. So the new information for this journal entry is that the equipment will be used for 5 years. This is important. This is 60 months. How do we know it's 60 months? Well, how many months in a year? 12. How many years did we say it had? 5. So 5 times 12 is 60, right? That's where we get that number from. On December 31st, 1 month of the equipment's use or value has expired, okay? So if the equipment cost us $240,000 and we think it's going to last us for 60 months, that's its, this is what we refer to as its useful life, okay? Right here, keep this term in mind. Okay, it's an important term. Then how much of it do we use up every month? $4,000. Okay, 240,000 divided by 60 is $4,000. That's all right here. So each month we are going to depreciate that account. Otherwise, we're going to expense $4,000 of that, okay? So on December 1st, we paid $240,000 for the equipment. At the end of December, we've used 1 month's worth of it. We've figured that allocation. See what I tell you? Oh, allocation makes us smile. Not little smiley faces. Big smiley faces. We love allocation. Allocation right here, $4,000. We're allocating $4,000 of cost every month. That gets us to this point where we took that $240,000 less the $4,000 every month. Now we have a new balance of $236,000. Okay, that's the remaining cost to be allocated over the next 59 months, right? Okay, so that's kind of what's happening in the background there. This is one of the more scary journal entries for you because we're throwing around new words like depreciation and allocation, right? But those are fun things. Depreciation and allocation are literally my favorite things that we do in this class. So if you hear me get a little bit excited about it, try not to be too worried about me. I'm fine. I just really like the allocation and the depreciation portion of this. So let's go ahead. This video may last a minute or two longer than we typically go for on these 10-minute videos, but I want to get through this transaction 3 with you guys. So what accounts are affected? Well, depreciation expense, we talked about that, and then accumulated depreciation. This is a fun account, okay? Fun, all right? This is what we call a contra asset account, okay? This just means it holds the opposite balance of your asset, okay? So since our asset holds a debit balance, because it's an asset, your contra asset is going to hold a credit balance, okay? And that's because it is sitting there reducing the value of your asset on the book. Okay, this is where we got that term net asset, right? Or maybe you saw it put as building, right? Net of depreciation. Okay, you'll see it listed like that. There's several different ways that they list these things out. Okay, but a contra asset, this is one of the more difficult concepts to kind of try and explain to you guys, and I don't think it really makes sense until we actually see it on a balance sheet, because what you'll see typically is you'll see building listed out here, right? This is your asset, and then you'll see less accumulated depreciation, right? So your building's worth $100,000, and every year you depreciate it by $10,000. And so you have your total building is actually worth $90,000 right now in your book. Okay, so that's typically what you're going to see on your balance sheet. That's the way we're going to present it to you. But for right now, we just need to know we're impacting depreciation expense and accumulated depreciation. Now, do these accounts increase or decrease? Well, we're going to increase depreciation expense, okay? And we're also going to increase accumulated depreciation. These are both increases. But you'll notice here that an increase to accumulated depreciation is actually a decrease to assets, okay? So, do assets equal liabilities plus stockholders' equity? Yeah, they sure do. They still do. We have a decrease to assets and an equal decrease to stockholders' equity. Again, we put this nice little note in here for you to be careful, because your increase in expenses is actually a decrease in stockholders' equity. And then if we look at our little table down here, we can kind of see what's going on. Our balance on December 1st was $240,000 on that equipment. We used up or allocated $4,000 of expense to it. So the new balance is $236,000, right? And the journal entry will look like this. So again, just a reminder, this is an adjusting entry. We adjust balances. So it's correct. Okay, that's all we're doing here. We're going back at the end of the month and we're looking at our account balances and we're going, hey, wait, we actually did some things here. We actually used up some of this resource. So we've got to recognize this expense, and we've got to adjust our resource accounts, our asset accounts, so that they match what's actually happened here, so that our balances are correct. So here we've got that depreciation expense. That's the increase to an expense, right? And then we have accumulated depreciation. This is a decrease to an asset, right? Which this does make sense, right? Because if you want to decrease the value of an asset, what do? You credit it, right? But here it also makes sense in another term. Let's look at it from a T account perspective, right? So it increases on the credit side and it decreases on the debit side. So let's say we've got building right here. What's its T account look like? It looks like this. Let's say we've got a $100,000 building, okay? And each year we've said it will depreciate by $10,000, right? So each year, this accumulated depreciation for building increases by $10,000, right? So this is year one, year two, it's going to increase by another $10,000 and so on and so forth. And you finally, at the end of year two, you got $20,000 in this account. What we would do is we would net these two together, right? So we would say 100,000 less that 20,000 total gives us a net value on our building of $80,000. Okay, so that's what the accumulated depreciation account is doing. It will literally sit right next to your asset account and just reduce the value of it. Okay, so I know that is kind of a trickier example, kind of a trickier concept to talk about. So if you do have any questions, please don't hesitate to contact me or contact the GA and just let me know. I am more than happy to talk to you guys about it.